Good afternoon, everyone. We will get our webinar underway here momentarily. We have additional folks dialing in, so please bear with us a bit longer, and we'll get started here just in a few seconds. Just another 30 seconds or so. The meter continues to tick up with attendees joining the webinar, so let's give them another 30 seconds or so, and then we will get underway with our webinar. Okay, folks, I'm showing 1:31 Eastern time here, so probably best we get underway so we can get in all of our content this afternoon. My name is Paul Smith. I'm a Senior Vice President with the organization. I'm the moderator of today's discussion. I look forward to having a chat with our panelists representing three separate areas. Let me please introduce them from left to right on my screen, at least. Jordan Muckway, Manager, Commercial Insurance, Burns & Wilcox. He's in Arlington, Texas. A little wave from you, Jordan, for the group. Next in the middle, I show Scott Lane, Associate Managing Director, Property Broker, Burns & Wilcox Brokerage in Atlanta, Georgia. Welcome, Scott. And last but not least, a person that you've seen on earlier webinars. We always have so much to say about personal lines, and we're really glad to have Anela Newhouse on the call today, Associate Vice President, Regional Practice Group Leader, Personal Insurance, and she is located in our Morehead City, North Carolina office. So hello, everyone, welcome, and we will get underway at this point. Just one quick housekeeping item. If you do have questions, please enter those questions in the box at the left. To the degree that we have time, we will certainly get to those. If we do not have time for some reason, we will capture the information and get back to you via email or phone call. So please ask questions if you think that that we could address them on today's webinar. If not, we will get back to you separately. So thank you, everyone, for your time this afternoon. Looking forward to this discussion. As you know, we do this on a quarterly basis, and this quarter is particularly of interest to me for many different reasons. The first of which is that all of us on the call here are fresh back from what I would call the industry's premier event, the Wholesale and Specialty Insurance Association, or WSIA Annual Marketplace Conference in San Diego. That took place just a few weeks ago. There are approximately 7,000 individuals gathered there regarding the E&S and specialty marketplace, folks candidly from all over the world. So I thought it would only be appropriate today to ask each of the panelists to share with the participants on today's webinar the highlights that you each had within your area of expertise. So Anela, might I kick things off with you, starting from a personal line standpoint?
Sure, thanks, Paul. So this was my second time attending WSIA. Last year was the first, and I would say that the mood was completely different this year than it was last year. Some words that I would describe the majority of the meetings we went to would be positive, hopeful, optimistic. There were conversations around rates starting to settle down and slow down in certain parts of the country. Inflation isn't as high and rapidly growing as it was last year. And even some of our partners are looking for growth again, which was really, really positive to hear. That being said, I know that not everyone's meetings went as well. However, due to our expertise and proven results in the personal insurance space, we had a really, really successful trip.
Yeah, that's terrific. And that's certainly what I picked up too in the hallways there, Anela. Particularly regarding the meetings that you all had in the personal lines space. Scott, if I could go to you next, I kind of think that there could be some similarities, right? You're in the brokerage property space, for lack of a better term. Anela is in the personal lines space that, is predominantly driven by property these days, not to diminish the liability aspect of it, but did you see similarities? What did you see from the brokerage property standpoint at WSIA?
Yeah. There were a lot of positives, and it was great to see people and hear the stories. There were a lot of things that we hear that, I don't know if Vanilla may hear, but we hear that submission counts are high. They're overburdened. So the message was, make sure when you send in a submission, make sure it's a full submission, a good submission. Otherwise, it's just going to sit on the stack. Follow up with a call with them. I know a lot of people in the past, it's all email, but there needs to be a call to our underwriters to see what's going on. And that communication level has to be at a high level if you want to get a quote. And as we all know, and I don't know what's happening on the personal line side or Jordan's side, but quotes for us, we used to get 30 days out, 45 days out. Now we're lucky if we get them 2 weeks out. And again, it all goes back to that number of submissions they're seeing and being bombarded by everybody. So they're trying to go in the right direction to make sure they're getting to their renewal quotes, some new quotes. So it's just a difficult time for them, but they're willing to still work with us. And all it takes is a quick phone call and, hey, this is a real opportunity. Let's do something on this. And, kind of give them some guidance when you send it in too, like where we need to be, what kind of rate we're looking for. Even though we want to see something lower, it doesn't always end up that way. But the bottom line is to, have that communication.
Absolutely. Be realistic, of course, is really what I think it comes down to. You hit on a bunch of topics there, Scott. I'm going to come back to you on a few of those. Quality of submissions, relationships, making a phone call after the submission goes in, all really, really important stuff. Sounds simple, but really important in this marketplace. Finally, Jordan, I want to kind of go over to you more from a kind of a commercial liability perspective, right? So on the commercial side of the house, but not so much property, more from a liability standpoint. What were your takeaways at WSIA?
Yeah, WSIA was great. As a whole, I think the commercial liability space has exponentially grown the last 3 years. So coming with that growth, obviously, it kind of takes a second look. I think a lot of the carriers, a lot of the conversations we had overall, they're reevaluating their book. And so what that looks like is they're looking for more growth. We expect the E&S casualty side to grow. But at the same time, it's really more of a common theme of strategic growth. So what that looks like is really a deep dive into their book. What do they write that's, doing well? What are areas that they could maybe change or carve out? And so really as a whole, from the blanket level of a casualty side, we're seeing that the carriers are kind of going after that strategic growth plan, maybe dipping their toe in a new area, but not going full force. But that said, continuing to write the business that they do well. And so, yeah, that's kind of what we're seeing on the casualty side. If the casualty market does have a property arm, we are noticing that they're pushing more business to the casualty side, right? So if it's a small package deal, monoline property is kind of coming off. And so the casualty side of that, we're seeing a lot of the push for writing more of that casualty business. So that's kind of what we were seeing at WSIA, and it was pretty positive.
Yeah, no question. I think our carrier partners, for the most part, want to balance their portfolio, and the property being as difficult as it is right now, they want a little bit more of that casualty business. Yeah, I'm going to go off script real quickly. Jordan, if you can just explain to the audience the Charles Schwab stuff on the wall behind you, and just in 30 seconds or so about our brand ambassador and why that's important.
Yeah. So we do sponsor golfers in the PGA, and Max Homa is obviously one that we do sponsor, and he's currently very active. And he's been tremendous as far as representing Burns and Wilcox, as a brand, putting our name out there. I think our partners, carrier partners and retail partners both see just the impact that it's created over the course of the years that we've been, representing in that space. We're one of the, it's definitely something that's not seen a lot in our side. And so I think it's been very important. We've had a lot of traction overall, and it's been nothing but success.
Good. I just want to make sure everyone, I have the ampersands behind me. I know Anella has one on the top of her bookcase. I'm sure Scott has one close. I just want to make sure everyone knew that you're representing Burns and Wilcox today. Anyway, so off script. Hey, Jordan, I am going to stay with you though, so keep your mic on. So there's certain segments within the casualty world, classes of business, for lack of a better term, that are perhaps a little bit more challenging and difficult than others. Do you believe that these lines will start seeing moderation in the next, say, 18 months throughout 2024?
Yeah, Paul, we're going to see, obviously, casualty as a whole. There's going to be segments that are going to continue to stay hard. They're going to be tough, and some of those classes include habitational, liquor liability, transportation, new residential construction, among others. But what we're going to see in that side is continued limits, and basically they're going to be limiting or trimming additional coverage items such as assault and battery. They're going to be looking at unit counts on HAB, crime scores, prior losses are going to be key. That's really what's driving the hard market right now on those classes of business. Liquor is the same. It's really the state dependent. Depends on what the state we're looking at, but it's similar to have lower product offerings. A and B is going to be sub-limited. That's if it's offered at all. We're seeing shorter limits in that space. Transportation the same. Fewer players in that space coming in and out. Really just chasing their tail. And new residential construction, that's basically following suit as you get construction defect claims and stricter builder requirements. So you get a more strict approach to what they're requiring the insurance carrier to provide. And so outside of those classes, and again, there are others, some areas of moderation or some softer segments of the market from a casualty standpoint, products, manufacturing, that's a big portion of what we're seeing. A lot of casualty companies coming in telling us they want to write more of. They are actively trying to reduce. There's just because of the amount of casualty companies that are wanting to get into that space, it does drive competition and results that the rates will come down. So we do see that. Commercial construction, another area of the casualty space that we're seeing a lot of people want to play in. And so that's an area. And then environmental, there's a lot of companies that are writing environmental. A lot of their coverage forms may be a little bit different, but in the environmental space, we have seen a little bit more of a softer approach and more players in that game. So as we see, more moving towards that soft direction, there are still going to be areas that are going to remain hard. Rates are going to go up. And so it really does just depend on the class. But yeah, that's what I would say as far as a softer area.
Okay, hey, thanks for that. Clearly, class driven versus on the property side for Scott, more location driven, right? So, but a little bit of location. You mentioned on liquor, right? It depends state by state, dram shop laws and things like that. So there's a bit of that. So you really can't broad brush the marketplace is kind of what I'm hearing you say there. So thank you. Appreciate your insights, Jordan. Hey, Scott, I'm going to move to you now and kind of change gears a little bit. What are some of the messages that carriers would like us to relay to our clients and factors that need to be addressed at renewals now, perhaps more so than ever before? Talk to me a little about that.
Absolutely. That's a big area. This year, and actually started some of last year, that the carriers started telling us that values have to move. They have to go up. They have to be changed. In years past, apartments could have gone for $85 a square foot, and now they want them over at least 110. We run CoreLogic reports on some of these places just to see where we are. And it's interesting because that is the message I heard from everybody. They want those ITVs, and that's insured to value. And in order to get insured to value, you take your building value and divide it by your square footage, and you get a cost per square foot. They want to see those up. So there's no more, here's your renewals, same as last year. That's not going to work. And that's the message we have to deliver to our producers, and they have to deliver to the insured. They have to talk about the values need to change, and here's where, and again, we're not being told what needs to be on that value, but we're told that they have to be increased. And a baseline that we've seen on just frame, so we'll just take the lowest class, frame, is starting at around $110 a square foot. And that's all due to inflation and cost of goods and that whole, debacle that's been going on for the last few years, starting with COVID, where everybody couldn't get things. Things all went crazy. And then from there, carriers are needing to see those values raised. And if we get a submission in and somebody says, oh, the values haven't changed, well, we stop it right there, because we're not going to turn around and send it to our carrier. We already know it's coming back. They're going to say, I'm not accepting this. And I mean, we've got several right now. We're having to talk to people and they're like, well, what should we use? And well, that's not up to us. My suggestion is go get somebody to, run a report for you. Now I can run a CoreLogic report and tell you what, the CoreLogic report says. It says it should be at least 115 or whatever it is. It just tells us a number. And we can go with that and try that and see how that works. But that's got to be relayed down line to the insured. And the insured has to understand that there's nobody going to build a building now for less than $100. I mean, you just have to understand that your building is an MNC building, a concrete building, a brick building. You're not going to build that for $120 a square foot. You're talking somewhere up to 200, 225, whatever. So the message has to be clear that things are changing. Underwriters are looking at this. They're going to run their reports. They're going to have a value that they want to see. And if we're close enough to that value, then we'll get a quote. But if we're somewhere way off, there's going to be a lot of talk back and forth. And in order to save that time when they're way behind, as I mentioned earlier, we need to give them a good submission. So our job as a broker is to stop that process before it goes forward, talk to our people, and which we do way in advance, by the way. We're trying to get it out, to people to say, listen, we're trying to get 90, 120 days out. We start the conversation. You might not have all that information, but we're going to start that conversation so we get the ball rolling. So somewhere around 90, 75 days, we get it in, and we understand we're not going to get a quote back until 2 weeks out. But we have the conversation now with our underwriter, and we go back and forth, which our producer doesn't get to see. We're over there fighting because they're like, well, we need this. And so it's a battle. Both, I know our producers have to go to the insured with these increased values, which nobody wants to hear. Not only that, they got the increased rates, that are coming on top of that. So nobody's really happy at that point. Unfortunately, it's the market we're in, and it's very tight.
It ties real nicely, obviously, to what you said a couple of minutes ago regarding quality submissions and thorough submissions and all of that. The part that I took from that, the highlight for me is let's try to keep time on our side and let's start the conversation earlier than we would have in the past. You can't just mail it in and say, renew as expiring. I don't have time to update my limits or whatever the case may be, or values in this instance here. So, hey, I think really great advice for our listeners today. Anela, I'm going to pivot to you now and change gears a little bit. Talk to us about how our clients, our producers, as Scott has just referenced them, can better prepare when it comes to a lot of these changing renewal terms that we just talked about, whether it be pricing, deductibles, limitations and coverages. What can they do to best prepare for that?
So I think, Paul, you hit the nail on the head with something you said a moment ago, and that is time. Looking at accounts earlier and not just 30 days out. We try and touch accounts in the personal line space at least 90 days out, where we're at least seeing the account before it goes to renewal, so we can ask those questions of our retail clients, and if, is it still a builder's risk? Is it still vacant? So on and so forth. But as far as changing deductibles and limited coverages, increased pricing, it kind of comes with the territory in the E&S space right now. However, there's ways to combat that in some ways. Being creative, we have, there are products out there for when deductible buybacks, if higher deductibles are an issue, or if there have been some claims, then maybe we get creative with special deductibles. So it's having a conversation and really being in the know on each specific account, which of course gets difficult because everyone's got a million things to do and a lot of clients to serve. However, in the space that we're in, each risk is unique and deserves that attention. So I would encourage our clients to reach out to their underwriters if they have questions about an increased deductible or a coverage restriction. Maybe a water damage sublimit was added at renewal due to a prior claim, or We had to exclude wind because that area is no longer accepting wind capacity, that sort of thing. Having that conversation, because if they can better understand it, they can then better explain it to the insured, which helps everyone.
Yeah, agree with you 100%. It's, again, whether it's commercial or personal, we need to get time on our side and we need to work closely with our clients. It sounds as if, there's a lot of changes going on right now. So it's taking us a whole lot more time to do the same things that we may have done historically because of these changes in the market conditions that we find ourselves in. So thanks for that, Anela. Anela, I am going to stick with you at this point. I have another, kind of question here and really more of a comment. Certainly some very, very exciting news lately regarding the Burns and Wilcox capacity afforded to us from various carriers within the personal line space. I'm hoping that you can share with the audience today a quick summary of what that's all about. Hopefully they've read about it in the various periodicals, but maybe a little bit more detail from you, and then hopefully some phone calls will follow.
Yeah, I would be happy to do that. As you said, we're really excited. We have 2 new exclusive products for both coastal and non-coastal risks. And not only are they new products, but they're also with new partners as well that we've not partnered with before. So that's even more exciting. And they both center around all sorts of risks, so lower coverage A all the way up to a higher coverage A, which is fantastic. We also have partnered, or I should say, we partnered with a large domestic carrier a couple years ago, and I'm happy to say they have given us really big growth goals for the upcoming year, which is really refreshing. And it's in all parts of the country, so coastal exposure, wildfire exposure, in the Midwest, we've got capacity there, and they would like us to continue to be one of their largest distributors of their product. So, I mentioned before in the first question you asked regarding our expertise and proven results, the fact that we are able to continue to grow with our product line and grow our portfolio within the personal line space is just fantastic when you're seeing a lot of our competitors out there that are not able to do that. So it just goes to show that, we are, if not the best, we are the best in the personal line space in the country. And being able to continue to get new products from carriers definitely proves that.
I think it's a trust factor, Anela. We are the best. Let's just underscore that. There's no question about that. But just the fact that our carrier partners trust us with this coveted capacity to do the right thing. We've been at personal lines, I say it all the time, and I think it's worth repeating here, for decades, not years, but decades. We've built a database of information, we've built knowledge, we've built trust in our carrier partners that is just unparalleled. The other thing I think that's worth mentioning here too, just to underscore your comments, Anela, is that we vet all of our carrier partners very, very carefully. And the folks that are listening in today can rest assured that this is high quality paper from an AM Best rating perspective, as well as other rating agencies. It's not something that you wouldn't be proud to represent to your clients when you bring it to them ultimately. So thank you for that, Anela. And hopefully we get lots of phone calls from our retail clients that are on the call today asking us for additional details about that new capacity that's recently been afforded to us. Thank you for that. Hey, Scott, I'm going to pivot over to you now. And hey, I'm a casualty guy, so I always have to ask property guys these kinds of questions. But it seems like that there's been a lot of kind of changes with how carriers are going about things in the property marketplace lately. And we talked a little bit about it a few weeks ago when we were preparing for today. So can you share with the folks that are on the call today what those big changes are from your perspective that are being kind of pushed into the marketplace now?
Absolutely. And Ella actually touched on it a little on her comments on one of those 2 questions. I can't remember which, but yeah, it was you're seeing a lot less capacity being offered. So, and I don't know whether it's their treaties or what's going on, but we're seeing capacity shrink. So an account that maybe came in last year, year before, 2 years ago, whatever, was $8-9 million in TIV. You get one carrier to do it. Now you're getting 2 and 3 carriers. Somebody wants to put up 2.5, and somebody who puts up 2.5 over 2.5, and so on and so. So you're having to building block these because everybody's capacity is shrinking, even though they, in the past, they would maybe put out 5 to 10 million. Now you're seeing 2.5. Not only that, you're seeing deductibles, and Nella hit on this as well. You're seeing deductibles for everything. You're seeing deductibles go up for AOP, for wind, all other wind, wildfire scores. You're getting water damage deductibles. You're getting sublimits for water damage. So there's a lot of stuff coming at people, including all the price increases and the ITVs, which creates a major panic in both sides of this business. Like, the carrier wants to retain the business, understands that they have to follow their rules. So they're kind of handcuffed at certain points that they can only do so much. We have to deliver that message. And again, we try to talk about this well in advance. We already know having done this, for years and years and years, you know what you're doing throughout the year. You know how to talk to people as accounts are coming up. You know how to kind of let them know we're going to have to market this heavy because the guys that are writing this part are going to shrink. They're going to give us half the capacity. They're going to raise your rates. So now we're going to have to building block this thing. And we talk through this so at least they have a message to bring back to the insured to say, there's no surprise coming. I want to let you know this is going to be a tough renewal. And that's the way it's been for at least 2 years now, and probably going to continue on. I wouldn't say we're going to see that 20% or 25% increase we've been seeing, but we're definitely going to see double-digit increases again going forward. So the message is, your deductibles are going up, your rates are going up, your capacity shrinking. It's still a terrible market, but it's our market and we have to deal with it. And I think somebody else hit on it too. It might have been Noah or Jordan, I can't remember, but talking about the influx of manufacturing coming in, and we're seeing a lot more of that in the E&S space as well. And it's normally a standard market play, but standard markets seem to be pulling back from a lot of things. And that's what's causing all that extra submission flow for our carriers, which is panicking them that they have 15,000 submissions they have to get through, in a month. And, they don't know which ones to grab. So that's what I say again, conversations, talking to people, letting them know what's coming, these capacity issues, the deductible issues. It's just something that we have an open communication with our producers with.
Yeah, Scott, when we were chatting about this a week or two ago, you mentioned something that I didn't know, and I thought it was very interesting. You said there's almost like a line of demarcation, and maybe Jordan, you would know about this, kind of through Texas on deductibles. Like if you're above this line or below that line, the deductible varies. I found that really intriguing. Maybe Jordan,
you're right.
Okay.
I'm going to jump in, and you're right. You're absolutely right. It depends on what part of the country you're in, what area you're looking in, like Louisiana, Florida, Gulf Coast, Mississippi. Texas is an interesting one because in certain parts, like North Texas, where Jordan lives, the deductibles are 3-5% now, when in the past there was no percentage deductible. And it's all because of that hail and wind and that convective wind. And so deep South Florida, what we call Tri-County, down in way South Florida, you're seeing 15% wind hail deductibles, named storm wind hail deductibles. And that's just, it's mind boggling to tell somebody you have a 15%. And by the way, that's the best one you're going to get. That's the best quote you're going to get. It's probably the only quote you're going to get. And it's just one of those things that it just depends. Convective storm in the Midwest, we've been seeing deductibles. They started out at 1%, went to 2, now we're at 3. Could be like Colorado, same thing, 3 to 5%. Never in the past have you seen those last few years percentage deductibles. So it's not only coastal now, it's everywhere.
Yeah, I've said it before, I'll say it again. Every state's a cat state now. We saw what happened in Hawaii not too long ago. So More important than ever, right? That folks read their policies because of all of these different things happening. And by the way, we have a best-in-class claims team here at Burns and Wilcox that can help you kind of navigate your way through those claims, because there's going to be a lot to navigate when you have all of these varying deductibles and perils and, you know, kind of shifting around and so forth. Hey, we do have one question from the audience, and I just want to let that person know that I will get your information and have one of my colleagues in Burns and Wilcox, Canada, reach out to you, because I think that the answer to the question is different in Canada than it is here in the United States. So we'll get back to you on that one. I did want to at least acknowledge the question. Jordan, I am going to shift over to you now. Need you to put your kind of liability hat on. And, you know, when we talked before about some of those difficult classes that you enumerated quite effectively, are carriers becoming increasingly focused on what I've always called underlying attachment points? And, you know, are they shortening their limits, continuing to shorten their limits to address these things? You know, what are they doing on those difficult classes in the event that you need to kind of build a tower?
Yeah, thanks, Paul. So excess as a whole has been kind of a tough segment in casualty. We're seeing a lot of changes in the space overall. In terms of the classes of business or the tougher classes in casualty, we are definitely seeing shorter limit offerings. So they're capping maybe at a 2 mil excess, whereas before they were at a 5. That's definitely common. Contractually, we're seeing just higher excess limits required. At the same time, excess carriers kind of reserving themselves and not putting themselves out there at such high limits. And so maybe a 5 million, you know, minimum excess is what they were required, you know, a year or two ago. Now they're 10. And so with that comes, you know, a little bit of really a challenge as a whole. You're going to get higher attachment points. So you're going to have to build layers, right? You're going to have to build a 2 mil, maybe a 3x a 2, and then another, you know, maybe a 5 over that 5. You know, we're seeing that just to build 10, right? Just to get to that 10 figure. So as a whole, if someone's in the lead right now, and they're taking that lead, they want the short limits, you know, they may cap at 1 or 2 mil, with no room to budge. And, you know, with that said too, the admitted space, we're seeing a lot of the admitted space come off. So I'm seeing a lot of submission flow, coming from where, you know, your admitted carriers are going to offer the primary. And now all of a sudden we have an opportunity to write the excess. And we can place the 5 mil there. So there's more opportunity right now in the E&S excess space. A big point or a big factor of what's driving the change is obviously auto heavy deals. Anytime you get a large auto schedule that the excess carrier is having to write over, it makes it very difficult. That's obviously a loss leader on the excess side. And so we're seeing a lot of the excess carriers kind of be more reserved. They're having more unit limit accounts. You know, they're taking those, if there's, you know, say they would offer 10 before, 20, 30, whatever that may be in their case, they're kind of lowering that number of total autos that they would be willing to write over. So definitely restrictive. We are seeing that residential, new residential construction as well. I mean, in the excess and HAB and all these classes that are a little bit tougher, excess carriers are definitely more conservative. And that's a lot to do with the litigation. It's hitting the excess layers a little quicker. And so as a result, we're building multiple policies, like I said earlier, to get to that 10 mil, 20 mil, whatever that tower may be. And that means more business in the E&S space, more policies, makes it a little bit more of a challenge. But yeah, as a whole, excess is an area that we're doing very well, and we're seeing a lot of growth, but it has its challenges. So
thanks, appreciate that. Hey, another question from the audience. This one's geared more toward both Anela and Scott. I'll paraphrase it as best I can. Client had some hailstorm damage. Roof was damaged. It's in the process of being replaced at the moment. The standard market is not interested in it because it's not completed yet. Is that something that we at Burns and Wilcox could work through in the E&S market? A roof that's kind of halfway repaired, if you will, because of previous hail damage, clients moving from admitted, and hopefully that there's a non-admitted answer. Either one of you have a position on that?
I do, but I'll let Anella talk first.
I'm not sure, again, whether it's commercial or personal. I'm thinking it might be personal, Anella, so you might be best.
Sure. Yeah, that's definitely something that we could look at. Some of our programs do have the ability for us to put a roof exclusion on there, or some sort of actual cash value endorsement onto the policy until that roof is fully replaced and finished. But it's definitely something that we can look at and falls in line with the type of risk we see.
Okay, cool. Thank you. I kind of assumed that was the answer, but just wanted to make sure. Hey, another question from the audience. Audience is pretty active today. Are we seeing residential construction projects slow down? Any of you guys have a position on that?
I don't think we are. We're still seeing a ton of builders risk submissions. So
Yeah,
Agreed.
yeah, we're seeing a ton of builders risk, new residential. It probably depends on the area. I'm in Texas, and so we're blowing the doors off as far as new residential homes are concerned. Apartments are as well. I mean, we're seeing a lot of growth down here in this region. No, I don't foresee it slowing down. Obviously, the economy is going to affect that, as there's changes there. But so far, no, it's been a full force of growth.
Good.
I agree. We're seeing the same thing. We're seeing the same thing on the commercial side. We're seeing a lot of apartment buildings. We're seeing a lot of renovations. So you're taking a strip shopping center and turning it into condos or whatever. There's a lot of remodeling going on, and it all depends again on where you are as to who wants to look at it.
Another question from the audience, and we'll get back to you. I think everyone on that one. I'm going to lean on my marketing folks that work with us to prepare today's webinar. They're looking for contact information for the panelists, so we'll certainly provide that to folks in a follow-up email. I don't want to take up too much time here to do that. Certainly, we would love the opportunity to speak with you in greater detail and finer detail, regardless of what the topic is, including other folks, right? Professional liability, some of our practice group areas, we do it all. So be more than happy to have that dialogue with you. Hey, Anella, I'm going to go with you on this one here. I had the terrific opportunity last month to attend an event here in New York City with our National Flood Practice regarding them being nominated and ultimately chosen as Underwriting Team of the Year by an independent panel of insurance executives. Can you tell us more about what our terrific flood team is doing on both the personal side and the commercial side?
sure, I would love to. When I joined the practice group, Brad Turner, who is the product leader for the flood team, was in the process of starting to take our flood program from a small geographic footprint just in the residential space and turning it into a national program. And the fact that he and his team were not only nominated but chosen for Underwriting Team of the Year does not surprise me whatsoever, because they are, in my opinion, and probably the opinion of many others, the best flood team in the country. So some of the stuff that I know that they've been doing from speaking with Brad, they did roll out a parametric insurance program on the commercial side recently, which is really interesting. Parametric insurance is definitely one of the hot topics and growing tremendously. And again, that is in the commercial space. However, if it is a residential property in the name of a commercial entity, that's something that they can look at as well. He and his team continue to use all sorts of different technology to underwrite each and every risk that they get. It's not a plug and play underwriting type thing that they do. They look at every risk on an individual basis. So if it comes in and, a standard write your own flood policy was not working for it because of the diagram number, or because it has an elevator in an awkward location or something like that, Brad and his team really look at it and underwrite the risk, look at storm surge, that sort of thing, versus just plugging it into an algorithm and saying no right off the bat. So with the NFIP being, in the condition that it is currently, and, continued talks about the future of where that will head, primary flood is, again, a hot topic. So I encourage all of our listeners out there, if you are not familiar with the private flood sector, that you reach out to one of us and and get educated on it, because I think that we will be seeing more and more of it in the upcoming years.
I've got
Thanks.
something else to add to
Yeah.
that, because it hit on a good topic, the parametric. It's an interesting tool that we've been using. We actually found one recently. And the parametric tool in flood is they go out and they put out markers. So if the flood gets up to that certain level, there's no conversation about what'd you lose, what they just pay. And there's a certain level each it goes up. Same with wind. We have wind parametric right now, which is really interesting stuff. That's the technology you're seeing that's coming into play. But the flood, I thought it was interesting because we had flood markets that didn't want to do this, and we got to the parametric one, and it was like, hey, this is interesting. Let's see if this will work. And sure as heck it did. It was like something that they wanted to go with. There's no conversation. If it hits this level, the check's coming. We're not even going to talk to you about what you lost. Here comes the check, and it's broken out into different levels, and it's very interesting stuff for sure.
Yeah, no question about that. One of your colleagues that'll remain nameless put a little something in the chat box here, Scott, that he wanted you to talk more about that. I'll let you know who that is later on. Hey, lots of a very, very active audience today, trying to keep up with my prescripted questions here, as well as things that are coming in. Another question from the audience, I believe Sandy asked a question about waiver of subrogation and builder's risk. Sandy, we will get back to you on that. And certainly answer that question for you with someone that is, can speak to that in finer detail with you. And then there's another question here, small print, bear with me a second as I try to get through it. So something about our carrier listing on our website. We'll get back to you on that one as well. I'll probably personally call you on that one and talk to you about some of our carrier access and what we're doing there. Anela, your last question, you talked a little bit about, you answered a little bit about, some of the technology that Brad and his team are using and all of that. So, one of the things that I came away from WSIA with last month was just about every meeting I attended, technology came into the conversation somehow, some way, right? From helping carriers underwrite business more efficiently, to helping carriers understand the risk profile better, to utilizing APIs to trade more efficiently, to find solutions, to put submissions together in a way other than an email with a bunch of attachments on it. So, technology, AI, APIs, all of those things kind of came together in this broad brushed conversation of technology. So, Anela, can you just chat a little bit about what's going on in the personal line space from a very, very broad brush technology standpoint? We have about 3 minutes left, so we need to keep it crisp here.
Yeah, of course. In the personal line space, we are definitely seeing more and more usage of third-party data, especially using tools such as like a hazard hub or a risk meter, that sort of tool where it uses different county databases to pull square footage and year built and all of that type of information to pre-fill and kind of do some frontline underwriting, so to speak. So we're seeing more and more of that happen, not only with our in-house exclusive markets, but a lot of our carrier partners are starting to see that as well. And then you touched base a little bit on the different types of modeling for convective storms, for wind, hail, for wildfire. We're seeing that come into play as well for different scoring systems, from low, medium, high, or 1, 2, 3, 4, whatever the case may be. But we're seeing a lot of that come into play more and more.
Terrific, thanks. Jordan, from your standpoint, more of a liability perspective, what's your view on technology?
Yeah, I mean, it's going to come into play. I think more so data collection and having, that data being collected and harvested as technology advances. The casualty carriers can actually use that data, look at it, create trends as far as, looking at their own book, what areas they want to dive into, which areas they don't, certain areas of the country. I mean, casualty can be a little bit harder in that space as far as tracking where the losses are going to occur, obviously with negligence a part of that. So, seeing realized losses from an occurrence tail perspective, they can collect and keep that data to maybe trend for the future. Overall, I think it's going to continue, and I think it's going to help out, the casualty area as far as what they're going to be able to do for projecting their losses. But yeah, as a whole, I think data collection is key for the technology side for casualty.
Yeah, no question about it. And I think there's a whole lot of emerging third-party organizations that are trying to gather all of that data and then sell it back somehow, some way to, actuaries, insurance companies, you name it. We're down to 1 minute. I always like to end with 30 seconds of wisdom that you have for our clients that have joined us today. What can they do to help navigate their clients through this difficult marketplace? Let me start with Scott, then I'm going to go to Jordan, and then Anela, you can wrap it up and we'll call it quits after that. So Scott, all yours.
Sure. I mean, it's like I said earlier, and I'll say it again, it's talk to them early, let them know. We see rates are going to continue to go up in the property sector. They hopefully will be leveling off. London, talking to London, they said, we understand that people can't keep taking these rate increases. So they see a leveling off somewhere 5 to 10% maybe over the next year or two. And again, everything depends on all the natural disasters. Everybody looks at hurricane as the big one, but as we've touched on, wildfire is now one, convective wind is one, and that's driving prices that people don't even factor into the thinking. They think, well, I don't have a hurricane storm in there, so why is my rate going up? It's everything. So communication. I'll just say it again, communication.
Yeah, just kind of adding to that. I think the big key is adding value to your submission, right? We have tons and thousands of submissions coming in. Add value to it, paint us a picture, let us know like where we need to be. I mean, targets are huge right now. The market is wild. So anything and everything you can give us up front to let us know more about that submission puts us in a better position to be able to get you what you need, what your client needs in order to sell the account, right? And to help out your client. So I think that's key. And then relationship, obviously keep the relationships heavy, strong, keep them going, stay in touch, communication, all of that is going to be key. There's just so much flow right now. Friends are going to take care of friends, and I think that's key.
Irrespective of technology, it's still a people business, no question. Anela, if you could just bring it home for us, and then we'll let our audience go.
Sure. In addition to what Scott and Jordan just said, I would also state educate yourself. The E&S space is only going to continue to grow as more and more of the admitted market shrinks due to profitability, oversaturation, you name it. So if you are not currently up to date with everything that is available within the E&S space, I definitely encourage you to research and find out because it's not going away and it's just going to continue to grow. So educate yourself.
No question about it. Thank you, everyone. Appreciate your time. Our subject matter experts, our clients that are on today, audience, others that joined us. We really appreciate your business. We appreciate you tracking us. The written version of this plus more detail will be out in about 10 days time. Be on the lookout for that. And you can certainly rest assured that at the beginning of next year, right in the beginning of Q1, we're going to do our, guess what, outlook on 2024. So happy to have everyone today. Thank you so much for your time. Enjoy the rest of your day. Bye now.